This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The first part of the syllabus deals with macroeconomics. And macroeconomics describes the branch of economic theory which deals with the big things in life. What causes unemployment? What causes inflation? What determines exchange rates? How can governments control unemployment, inflation, exchange rates? How can governments turn a recession into a more successful period of economic growth and stability? First thing that we need to look at is how would you measure the size of an economy? And this is normally done through measures such as national income and GDP or gross domestic product and GNP or gross national product. First of all, we have national income. What is meant by a country's national income? And really the higher the national income, the bigger the economy. And the national income is defined here as the country's final output of all new goods and services produced in a year. And final is important here. If you had a factory which made goods and sold those goods for $1,000 to a consumer, then that would be contributing to national income by $1,000. But what happens if your factory sold to a retailer for $1,000 and then the retailer sold to the consumer for $1,500? That doesn't mean that national income has suddenly increased from $1,000 to $2,500. Or if you had a couple of intermediaries, factory to wholesaler, wholesaler to retailer and so on, we're not actually making the country richer. We're not increasing the amount of end consumption just by adding in various intermediaries. So what's important is the final output of all goods and services produced in a year. Now, the gross domestic product is defined as household spending, what you and I would spend on food, on transport, on heating and so on, plus capital investment spending, which is typically what businesses will spend on machinery and plant and lorries and the like, plus government spending on health services, schools, police forces, defence and so on, plus exports, which are basically money or goods going abroad where we are then receiving income into our economy. There's imports, and imports is a kind of leakage. It's where money escapes from our economy and goes abroad in exchange for goods. So remember what that definition is. It is household expenditure plus capital investment plus government expenditure plus what we get from exports less what we have to pay for imports. Gross national product is the gross domestic product plus income we get from basically investments abroad. If it was a company which had a subsidiary abroad and that subsidiary sent back dividends to the owners, to the holding company, then the income from abroad counts as gross national product. It's almost a little bit like an export, but it isn't obviously an export of goods. It is profits being sent from investments abroad. The next concept, which is very important, is the circular flow of income. And you expect this to be kind of an equilibrium. So we spend on goods, and the value of goods going to us will equate with that. If you spend $10,000 buying a new car, for example, then the firm is going to provide you with a new car worth $10,000. Similarly, if you are paid labour, if you're paid a wage, let's say, of $1,000, then you are essentially supplying to your employer labour worth $1,000. And these are essentially most of the time in equilibrium. There can be disturbances or changes to the equilibrium For example, government spending. Let's say the government goes out and prints money and just kind of distributes that to people. Then, of course, what can happen is that the spending and consumption can rise. If the government were to give everyone an extra $1,000, for example, they could spend an extra $1,000, and for a little while, until production caught up, there wouldn't be quite enough goods and services. But the hope is that the extra demand will stimulate firms to produce more goods and services, and we come back down to equilibrium. The injections of money, which is going to go into the circular flow of income, can be government spending. It'll be exports where money comes in from abroad, and will be investments. And we've seen these three elements really in the gross domestic product. If we have money coming in from abroad, then obviously it's not households which are spending on firms. It is foreign customers who are spending, and this again will stimulate firms to produce more, which is going to be exporting. Withdrawals, or kind of leakages as they're sometimes called, from this circular flow of income will be taxation. Taxation is essentially where the government withdraws money from the economy. Of course, very often this will go round and the government will spend that money, but it doesn't actually have to do that. Savings. If you are receive income here and all you do is you say, well, I'm going to keep 20% of that aside, and you kind of hide it under your bed for a while, then of course this income here cannot be used by you to spend, because there's an equilibrium this way as well. Your income is what you're going to be using on spending, and the spending is what's going to stimulate the firms to produce goods. And finally, imports. Imports where money goes abroad, where you are not spending on domestic firms, you are spending abroad and money leaks out of the economy. So, if there weren't these injections and withdrawals, you'd expect the circular flow of income to be pretty much in equilibrium all the time. Once there are injections and withdrawals, then there will be temporary disequilibrium, but generally speaking, things will come back to an equilibrium at the end of the day. Now, all of this spending, this aggregate, can be called aggregate demand. It's a total demand in the economy for goods and services. It's a total desired demand. So just confining it to ourselves as people who are going to determine this national demand here. Here we have the aggregate demand here. Let's look at aggregate demand 1 here. As prices go down, then the output from firms will go up. Because as prices go down, we can afford to buy more goods and services, and this will cause the output of firms to rise. There will be greater demand for their products, and they will begin to respond to that demand by increasing the output. Aggregate supply is the total supply of goods and services. And what's happening here is that as the prices of goods and services rise, then firms will be willing to produce more goods and services, or more firms will come into the market and begin to produce more goods and services because they see a profitable opportunity. And what we're going to reach here is an equilibrium point. This is inherent in the idea of a circular flow of income, but at some price of goods in the economy, then the aggregate demand, what people are willing to spend for those goods, should be precisely matched by the aggregate supply, the number of firms and the volume which those firms are going to produce should precisely match what the demand is going to be. If they don't precisely match, then it might mean that firms are producing too many goods. And if producing too many goods, more than people actually demand, they won't sell, so firms will kind of pull back. If firms are not producing enough goods, then there will be an excess demand for goods and services, and the excess demand for goods and services, firms will recognize this. First of all, prices might go up slightly because people will be competing for these goods and services. And what's going to happen is that we'll come back to this equilibrium here as the prices basically come together. Now, moving up and down these lines, which is caused by changes in prices of commodities and services and products, you have to distinguish that from what's called a shift in the demand line or the supply line. Let me just get rid of these arrows which we've got in here, then we can look at that. So what we've got going on here is we started off with aggregate demand 1, and what we're doing is we're getting what's called a shift in the demand curve to the right. It's called a rightward shift in the demand curve. What this means is that at a specific price, more goods are demanded. So let's say that this is the price at which goods were demanded for these people here. So let me just draw along here. It's really what I want to be doing here. So what it is saying is at a particular price in here, let's call it $1,000 or something, for a particular goods or aggregate goods in here, initially the amount demanded here might have been, let's say 10,000 tons of some sort of commodity. Though we're dealing here with aggregate demand, we're not actually dealing with individual products, we're dealing with all products, all services and so on. But that particular price, suddenly people want to maybe buy 1,200 or 12,000. Now, why at a given price has aggregate demand suddenly increased? And it might be because people, for example, are feeling optimistic. What may have kept their output down, the demand down a little bit, initially in demand line 1, is that they were saving. They were worried about the future. And if they're worried about the future, they were putting 20% of their earnings into savings. But if suddenly the clouds lift and you're optimistic about the future, then you don't need to save as much. You're willing to spread the money around a little bit more, to splurge a little bit. And so for a given price, there was simply more money around to enable people to spend. And aggregate demand will be shifted to the right. If aggregate demand shifts to the right, then we will have in here, we have got the aggregate supply will gradually increase to match that demand until we have an equilibrium point again. Another reason that aggregate demand might be increased could be, for example, if interest rates decrease. So some of the demand is going to be really created by people borrowing. As well as earning income and spending your wages, you could go to the bank and say, well, I want to borrow $1,000 because I want to buy a new washing machine or something of that sort. If interest rates are up at 10%, then of course there's a considerable cost at borrowing money. But if interest rates were to drop from 10% down to 2%, then you're getting money for very, very little cost, and you will go out and you'll be more likely to borrow money that you can then spend on buying a new washing machine and so on. And this is one of the ways in which governments, and you'll see a whole list in your notes of the way that demands can be shifted to the right, aggregate demand can be shifted to the right, ways in which government might want to stimulate the economy. So if the aggregate demand and aggregate supply was such that the output was quite low, and it meant quite a few people were unemployed because their labour simply wasn't needed, because we didn't need them to produce the goods that the population wanted and so on, what the government could do would be, for example, to lower interest rates. Or what the government might do is maybe increase payments to people, increase maybe social security payments, and now people who are in receipt of social security payments suddenly get more money showered on them from the government. They will go out and they will be willing to buy more. And to buy more, the producers have to produce more. And to produce more, they have to increase the number of people they're employing. And that's going to stimulate the economy. Sometimes you want it to go the other way. Sometimes perhaps the economy is overheating a little bit, as is said. And the way the government can kind of put a lid on it and to reduce aggregate demand and to reduce supply is maybe by increasing the interest rates. Or maybe if the government was to increase tax, taking money out of the economy, and the government didn't spend that taxation money, maybe what the government does is take the taxation money and use it to repay some government borrowing, so that kind of doesn't give into the economy again. Then the government would be reducing demand, and this would mean that the suppliers would have to move back slightly in the volume they were producing. They wouldn't be recruiting as many people, and so on. Now, at some point, if the government keeps increasing, or the aggregate demand keeps increasing, so here we have aggregate demand 1, aggregate demand 2, we could have lower the interest rate again, we'll get aggregate demand 3. But at some point here, it's not going to be possible to increase aggregate supply anymore. Demand has gone up and up and up and up, but we're now employing everybody. We cannot produce any more goods. What's going to happen if there is demand which is unmet, simply because we can't produce any more goods? Well, the first thing that's likely to happen is that the price of those goods will increase. 100 people want goods, but there's only goods for 80 people. Then what's going to happen is the price will be bid up. And this is one of the major causes of inflation, where there is more demand than can be actually met by the factors of production. Another effect that might happen is that if there is full employment in our country and we can't produce any more, yet there is still this pent-up or potential demand from people, then it will suck in imports. People will be willing to import goods and to pay for those goods simply to satisfy the demand which is there. So aggregate and demand and aggregate supply is key really to trying to understand what's happening in the economy, what will make it grow, what will make it shrink slightly, and in particular what happens if there is too much aggregate demand, more aggregate demand than can be supplied, then you're likely to have this very sharp rise in the prices of goods, which is of course inflation. Here we have a full list of potential causes of rightward shifts in the demand curve. An increase in disposable income, whatever causes that. It could be that there's been a very generous round of pay settlements. So the government, and governments typically, many countries, they contribute to about 40, 45, 50% of the economy. If the government suddenly said, right, all our government employees are going to be paid 10% more, then of course there'd be a massive increase in disposable income from all government employees, and that would increase the aggregate demand. Consumers deciding to save less, and I mentioned that before, this is called a lower marginal propensity to save. They feel more confident. They don't have to put as much aside for a rainy day. increased government spending, perhaps, as I said, social security payments, a more relaxed monetary policy, and a more relaxed monetary policy could be lower interest rates, or making it easier for banks to lend money, fewer rules and regulations to try to stimulate them to spend money. A change in exports. So if we have exports increasing, if suddenly our goods become really, really fashionable and popular abroad, then of course the demand, not domestic demand, but the overall demand is going to be increasing, and our suppliers will have to supply more. Inflation. Inflation is something which governments keep a particular watch on here. Very high inflation is something which they don't really want to try to countenance too much. It's very, very wasteful, as we'll probably see. But what are the causes of inflation? Well, demand pull. This is what we've seen, where demand for goods exceeds the capacity for goods to be made, and this raises prices as people compete for this limited pool of goods. You have cost push. For example, a large manufacturer gives a very generous wage rise to its staff. The goods will cost more to produce, and therefore the manufacturer will charge more to consumers for those goods, and this is a cause of inflation. Import cost inflation. For example, oil. So if oil supplies increase in price and you're importing your oil or your gas supplies, then of course you're importing inflation into the domestic economy. Expectation. Expectation is where you expect next year's inflation to be 10%. So what you do now is you say, well, next year's inflation is going to be 10%. I want my wages to increase by at least 10%. So you kind of preempt the inflation. And finally, an increase in the money supply. For example, decreasing the interest rates, making it easier for banks to lend money, allowing banks to lend more and more money, and maybe keep less and less money back in case there's some sort of problem in the future with the banking system. And governments use these levers to try to limit the amount of inflation which is around. Inflation is troublesome. Inflation is unfair to people on fixed income, because your income is fixed, yet the prices go up and up and up and up and so on. Inflation tends to favour borrowers, because if I borrow 1,000 now, inflation, let's say, is 150%, then it means that I still owe my lender 1,000, but my income has increased by 50%. And after a few years, the amount I owe my borrower is almost trivial. But the borrower has lost out. A big one, the lender has lost out, and the borrower has enjoyed paying back the loan in many more years, when the money is being paid back in is actually worth very, very little. It also wastes an awful lot of time. People spend a fantastic amount of energy negotiating for their pay settlements so that they stay up with inflation. People don't want to save. Why would you save money if it's basically being frittered away through the effects of inflation? So over high inflation is regarded as being unsettling. It's bad for savers, it's good for borrowers, it's a huge diversion of energy for people. It makes planning very difficult in the future. And most governments try to set inflation targets, if they can get them, at around a very small 1-2% per annum, which is very difficult to actually get rid of, but which isn't going to do any damage very, very quickly.